Hi there, it's Mortgage Wise with Mike Wise at CMG Home Loans, and today we're going to be talking about the all-in-one loan that we have. And this is a new product to me, but today we've got the expert here, Dave, and he's going to go over it in details. But before we do that, let me give you a little bit of background and why I'm doing this. I've been in the mortgage business for about 30 years now, and I've done a lot of loans for people, over $2 billion worth of loans. And we've helped people get into houses, refinance their houses, lower their payments, really reach their dream of home ownership. And when I started at CMG Home Loans, I figured out, this is a good place to go, but the president, Chris George, called me up and basically said, you've got to learn about this all-in-one product. And who would have thought that there's a different way, a different loan program that I would love so much. And this all-in-one loan, we've had the 30-year fixed for 100 years now almost. And it's been so helpful to a lot of people. It's extended the term of the loan to 30 years and basically lowered the payments and put people in a great position financially. But now with this all-in-one loan, it's a different way. And Chris basically said, you need to get in touch with Dave. And Dave is the guy. He's taught everybody about this all-in-one loan. He's been doing it for the last 18 years. Since the inception of the product. And so I got in touch with Dave. Everything that I've learned so far, I've learned from Dave on the all-in-one product. But now here he is today in person. Thanks for being here. He is the Senior Vice President of the all-in-one product. And that's all he does. He lives and breathes the all-in-one loan every single day. So thanks, Dave, for being here.
Thank you, Mike. I appreciate you having me up here.
So I talked about the 30-year fixed rate just a little bit ago, and almost 100 years since the 1930s, that loan has been in process. So Dave, tell me a little bit about 18 years ago when you're developing this product. What was the problem that you were trying to solve? Why is this all-in-one loan different than, or what was it that you were trying to solve?
Sure. It's a great question. Ultimately, really in the early 2000s, one of the things that Chris George really noticed and that he still talks about today was a lack of innovation, a lack of sort of forward thinking, taking part in the industry. I think honestly the industry has focused nearly exclusively on making access to credit really the focal point of the industry, the primary objective. And along the way, I think that Chris feels that we've sort of lost sight with helping people not just gain access to credit and create affordability, opportunities in housing, but also to help people get out from underneath the debt, have an easier time doing that. And that became really the drive for Chris to begin to think differently about the way we pay for real estate. And out of these ideas came a product that we put forth with the brand name called the Home Ownership Accelerator, which is this product, the all-in-one loan. But we first introduced back in 2005 this product under that brand name, and it was really our belief then that helping people pay off their homes earlier, become mortgage free sooner in their lives was has a very meaningful impact for people, and that was the primary goal. We went to market with that brand name and that message, and it resonated. Absolutely, but 18 years later, I can look back and say that we've certainly learned a lot of new things as well about what this product can do for people and how paying off a mortgage is sort of secondary for a lot of people. And I can speak to that, of course, but that was our frame of reference at that point in time, and if you think back in 2005, where people were sort of leveraging their equity and taking on more debt, because the belief was, of course, that housing prices would continue to increase and everybody was safe. And we were putting to market a loan program that helped people deleverage that debt more rapidly. So it helped people actually, not just during that time, but also during the financial crisis of 2008, have an easier time navigating through that turmoil. But we've learned a lot since, and ended up rebranding the product, which is much easier to spell and remember. And I think it's much more reflective of its origins, and how it's structured.
All right. So Home Accelerator loan has now changed to the all-in-one loan. Mm-hmm. And we're going to start from like a 10,000 foot level here, and then we'll get into some of the details a little bit later. But tell me, from a 10,000 foot level, what is the all-in-one loan? Yeah,
the all-in-one loan is, in concept, it's the merging of personal banking and home financing wrapped up into one fluid financial tool that comes in the form of a mortgage. So let me repeat that. Personal banking, meaning just a personal checking account merged with a mortgage security that's used obviously to finance real estate, whether that's a purchase or a refinance, whether that's placed on a primary residence, a second home, or an investment property. It's the merging of the combination of cash flow management or income management in and out of a mortgage. And the idea behind this is to use money more effectively, sort of wash money in and out of what is otherwise the largest debt people generally commit to in their lifetime, to help shrink the size and the cost of that debt. Most Americans need to borrow money in order to participate and own real estate, and borrowing money comes at a cost. Traditionally we have to rely on interest rates to create affordability and savings opportunities. But this loan is really engineered to help utilize income dollars to offset the amount of interest people have to pay. To us, what this loan really answers or solves for is the fact that the amount of interest people pay on their mortgages tends to be more important than the interest rate that comes with their mortgage. And so when we have that discussion with people, it really opens up the opportunity to discuss an alternative in what the all-in-one loan is. So the merging of banking and borrowing into one place helps utilize money more effectively to lower the mortgage principal faster, and with it, the cost of the loan itself.
It's so interesting because we're, in a normal market, basically, as interest rates go up, the housing market slows down. Yeah. As interest rates come down, the housing market speeds up, and that's just because of access to lower rates on the 30-year fixed rate loan. Mm-hmm. And that's right. 90% of people that have a loan on their home is a 30-year fixed rate mortgage. And really, most people are focused, like on their car, same with their house, is they're focused on the payment. And what is my payment going to be on this particular loan? And you talked about paying less interest on that loan. And whether it's a 10% rate or a 3% rate, it doesn't really matter what the payment is. It matters how much interest you're paying.
Well, I would say that the payment always matters. Your monthly obligation towards paying a debt matters, of course, especially today, where interest rates are higher. And interest rates, by the way, are just a reflection of really the cost of living. Everything is higher. Food is higher. Mm-hmm. Just transportation, everything is higher in price today. Certainly, mortgage rates and rates on other consumer debt. So obviously what we are obligated to pay on a monthly basis to service our debt, it matters to people, especially as their cash flow, their discretionary cash flow gets squeezed, if you will. So the payment always matters, but it shouldn't always be just the exclusive focal point. Pay down and cost savings is also something that we find people are really concerned about. Everybody wants their home's prices or value to go up, but nobody wants to pay more than they have to for their home. Right. And ultimately, we're so kind of reliant on interest rate cycles being more favorable in order to create these opportunities in housing or savings opportunities. And if you think about it, it's sort of weird because none of us control. I guess collectively we all participate and somewhat have influence over these rate cycles, but none of us controls them, of course. So why do we have to be so dependent on interest rates in order to create opportunities for us to save money and reduce the cost of housing? And we don't. What we have to do is change the way money is used, change the way money is applied to the debt itself. Let's just restructure the mortgage. As you said, Mike, traditional lending has been in place since really the 1930s. The traditional 30-year fixed forward amortized loans put to market in 1938, and they haven't changed since. And opening up credit policy and accepting lower credit scores or higher loan to values, that's not innovation. That's just right. That's just kind of contracting or expanding with market conditions for production value. But changing the way a mortgage instrument utilizes money and applies it to principal versus interest is really what we're talking about here. And that's what the all-in-one loan changes. That's why it's so powerful. It's the only principal paid first, to my knowledge today, it's the only principal paid first mortgage product in America. So conceptually, you can already begin to understand how that is better for people, how it offsets even higher interest rates. The question is, can you save money and time even while interest rates are higher? Yes. A 10% interest rate mortgage designed to pay off in 6 or 7 years is significantly less expensive than a 2.5% mortgage, as an example, that's designed to pay off in 30. The math doesn't lie. The terms are really what it comes down to, and how money applied to the debt changes the terms.
So with this loan, you said principal first mortgage. We're going to get into detail a little bit later, but that kind of scares me. Principal first, it's like I don't want to do a 15-year or a 10-year fully amortized loan, because that my money goes into that mortgage and it's gone, and my payment actually goes up as well. So like the interest or principal first scares me a little bit.
Well, it's statistically very few people actually prepay down a mortgage. Of course, we all can do that. There's no secret here. Paying more towards principal more aggressively, ahead of schedule, will save time and money. People are reluctant to do that because mortgage instruments are illiquid, right? And most financial instruments we use, by the way, are liquid to some degree. I mean, you can access funds that you have been applying towards a 401k account, as an example. Most things that we apply or commit to large sums of money towards have some liquidity to them, except for the mortgage. In order to access your payment money back out, you would have to refinance, or you would have to go get maybe a second lien on your home. And certainly the incentive built into traditional mortgage products is to pay the least amount on a monthly basis. So we're sort of disincentivized, if you think about it, because they're illiquid products, to pay anything extra on a monthly basis, even though we know it'll save us some time and money.
Yeah.
And we solved that with the all-in-one loan. It's open-ended, not closed-ended. And what that means is you can put money into an all-in-one loan and take money right back out of an all-in-one loan when needed, whether that's the same day or tomorrow. It keeps money liquid for use, which builds, right, foundationally, begins to build the incentive to take greater control of what you owe and have much greater influence over how much you're being charged in cost.
So some people, this loan is different for everybody, right? Yeah. I mean, it depending on how much money you put towards the all-in-one loan or how much money goes through your checking account, and we'll explain that again in a little bit here. But if somebody were to ask me, well, I want to save $100,000, well, it's really up to you on how you manage this loan program, and it's very flexible in that way. Whereas on a 30-year fixed rate mortgage, like Dave said, you put your money in, it's a one-way street. It pays down your principal. You will not see that loan, that money again until you sell or refinance or get a second mortgage. And so that's super important to understand about this product is that you can still have access to this money, and you're going to build equity a lot faster by paying down the loan a lot faster.
I mean, think about it. It's great. But you mentioned as well, really the sheer statistically how many homeowners, how many mortgage borrowers utilize just the standard 30-year mortgage product. And of course, our belief, as you know, Mike, is not that the 30-year mortgage or a 15-year mortgage doesn't have its place. Again, these are products that are developed for a community of home buyers and homeowners who ultimately really need that stable payment plan. That's the upside of it. There's a predictable payment structure, and it's sort of a commodity item. There doesn't take a whole lot of education.
Month out, they know what that payment's going to be.
That's it. And again, for people that are sort of becoming newly established in their financial behavior and their budget, maybe don't have a whole lot of discretionary money at the end of the month. It's a very valuable way to finance real estate and get started. Then there's this whole other subset of folks, probably tens of millions in our estimate, of homeowners and prospective home buyers who are well established. The average age home buyer in the United States in 2022 is 47 years old. Average age mortgage borrower in the United States is 55 years old. Those most active in real estate are people who aren't newly establishing their behavior, but are actually well on their way.
Yeah.
And the conventional products, as a payment plan goes, sort of becoming a ball and chain. And our belief is that we should be developing sort of a battle axe, a tool to help people, have an easier time navigating, paying less when that makes sense, leveraging when that makes sense, reinvesting in real estate when that makes sense, and paying off as fast as they want to, tailoring the results relative to how they want to use it and what they need to accomplish throughout their life. I mean, that's one of the biggest benefits of the product.
That's awesome. It's an incredible product. I love it. I love selling this product to as many people as I can. I'm going to tell everybody that I know about this product, and some of them are going to like it, some of them are not going to like it, but it is a very great product for a lot of people. And we're trying to tell more people about it. So let's switch gears a little bit here and go into the details of the loan. So we've kind of hit the high level and kind of some 10,000 foot things about the loan program. Now let's get into the detail about it. It's a very easy concept, but it takes a little bit to understand this. So can you go into detail on, you talked about the mortgage and a checking account going together all in one loan.
Yeah.
So that is it, right? So tell me, go into detail on how it works.
Yeah. Well, let's start with a checking account for just a moment. Why a checking account? Why does this make sense? Well, let's just start with the fact that most Americans who can certainly qualify for a mortgage utilize one of them, right? Most Americans have at least one checking account. We tend to drive our income, right? It tends to be the initial landing place for our earnings.
Yeah.
What people don't, I think, realize is the sheer volume or the amount of money, the sum of money that actually flows through their checking accounts over time, in even a short period of time. Most Americans will earn more money and manage more money through their checking account, call it in just 5 years, than the amount they will owe on their house and a mortgage.
That's incredible.
Yeah, the problem isn't that they don't have the resources it takes to actually reduce their debt and the cost in their life more efficiently. The issue is that where we manage those funds is isolated, sort of on its own little private, desert island. We earn money, we deposit it into a checking account. That checking account is a separate financial product than our debts. And of course, that we pay typically a lot higher interest rates and a lot more interest over time on our debts, our liabilities, than we actually get paid in return for our use and loyalty to our checking account providers. So beginning with the checking account, there's a lot of money that transfers through these tools on a weekly, monthly basis. And that money otherwise, goes underappreciated, it's undervalued because it's not really being utilized by us consumers, us depositors. We begin to fix that by merging the checking account with the mortgage. Let's consider the mortgage for a moment. Mortgages will, as you say, front load the payments with interest cost. About 90 to 94% of Americans utilize a gold standard 30-year term mortgage, and a lot of Americans will actually buy upwards of 60, 90 years worth of mortgage term in just the course of 10 years, of course, because they chase interest rates to generate some savings opportunities. And again, people just continue to kind of stay stuck in that rut, in that front-loaded side of the mortgage instrument, right?
So what's the typical length of time somebody holds a 30-year fixed-rate mortgage?
Historically, about 5 years.
5 years. I've told people 7 years, so 5 years, and then they start it over again.
Yeah, and we'll probably see that continue to accelerate, given the idea idea that, we all know that at one point rates will go down from here. And, what we're going to see is, people that finance their real estate in the past, call it 18 to 24 months are likely going to run off those balance sheets and refinance again and restart that clock all over again. What if you didn't have to restart a clock? What if your rate reduced with the market, right, automatically? What if it was built into the product? So the all-in-one loan takes the checking account, the power of a checking account, the power of the income that flows through a checking account, and we add a feature onto an all-in-one loan checking account. That added feature is called Sweep Banking. Sweep, S-W-E-E-P. What that means is it transfers deposits automatically to the mortgage the day of deposit. So if I deposited $5 into my all-in-one loan checking account, that $5 is not going to remain there doing nothing for me until I need it tomorrow or next week. It's going to sweep to my mortgage balance and pay it down by $5. Go further than that. If I took what I would normally commit towards a regular mortgage payment, call it $3,000. If I deposited $3,000 into my all-in-one loan checking account, all $3,000 of that sweeps today and pays down my mortgage balance by $3,000.
Yeah.
And that's a huge benefit. Now go even further. I take my entire paycheck and I deposit that the day I earn it, or rental income, right, that I earn off a rental property. Tax refund, if anybody gets those anymore, whatever it may be. Any receivables coming in on a routine basis over the course of a year, the day that it's deposited into an all-in-one loan checking account sweeps and pays down the mortgage balance by that same amount. That's a benefit because how interest is computed on the all-in-one loan, which recomputes daily on whatever the unpaid principal balance is. So you now have the opportunity to lower your balance with money you've earned automatically to create a savings.
So define recompute daily.
So recomputing interest daily means a simple interest calculation. We're taking what is owed on the mortgage balance, the principal, at midnight, multiplying that by the interest rate, the loan's interest rate, and dividing that number by the number of days in the calendar year, 365. And that equals that day's interest cost. Now the customer isn't charged interest daily. It's just recomputing interest daily over the monthly period. What that does is it engineers the lowest possible interest cost on the mortgage for that monthly cycle.
Because the lower your principal balance is, the less interest you're going to pay.
That's right. We're basically computing interest on a daily basis and summing that total up at the end of the month, and that becomes the interest payment. What we've done is we've separated the principal from the interest. Principal is paid by making deposits and leaving money in the account. It already goes towards the mortgage. And interest is charged only after the month is ended.
Okay, so now we're a little scared because you've taken all the money out of my checking account and I don't have any more money in that checking account to pay for my bills. What happens when I have a bill that needs to be paid?
Yeah, you pay it right from your mortgage, right from your all-in-one loan. And the reason that's possible is because the mortgage side of the all-in-one loan isn't your standard closed-end 30-year mortgage where you can't pull money back out. Instead, it's a first lien position, 30-year draw, home equity line of credit. The only one that I'm aware of in the United States today. 30 years worth of usage. Put money in, take money out, money in, money out freely. The way money is put into it is by making deposits into the checking account.
Yeah.
The way you take money back out is by, again, using the linked checking account, the all-in-one loan checking account. So you pay bills like normal.
So the checking account, it comes with online banking, it comes with a checkbook, it comes with
bill pay,
ATM card, everything.
Mobile deposits.
Everything.
You could write me a check today like you're going to, and I could take a picture of that through the all-in-one loan app, and my mortgage balance goes down today. Right, and I could pay a bill tomorrow, and that money comes, drafted right off my all-in-one loan line of credit automatically for me.
So then the balance actually goes up.
Correct.
And you're starting to pay more interest on that just because it's a higher balance.
And this is where some people get caught up, right? Well, gosh, how am I going to save money over time if I'm spending, good some of that money right back out? I've got bills to pay, and it's a logical, question. The reality is there's a few things going on here. Number one is that the initial impact to principal lowers the daily balance in which interest is being computed on nightly. We also know that money tends to be spent out periodically. You don't get paid on the first, and by the second, you're completely drained.
At least we hope not.
So, if you can qualify for a standard mortgage, you're likely not that individual. So we know that money tends to get spent out towards your weekly expenses and monthly bills. Like a cell phone bill is a one-time monthly expense. But food, grocery shopping, things like that may be a weekly occurrence, right? Maybe not every single day, but maybe a couple times throughout the week. The point here is that money tends to float in our accounts, right, waiting to be spent on our living expenses. And while that float occurs, that money is being utilized to keep the daily principal balance of your mortgage lower, in which interest is being computed on.
So let's just define float a little bit more for everybody. So what do you mean by float?
Time. It's sort of, we refer to it as sort of lazy money that's awaiting to be spent. Most of our income dollars are going to be utilized just to support our living, our lifestyle, our living habits, utility bills, cell phone bills, food, entertainment, all these things. Again, not spent out of our accounts all at once. It's done really on a weekly and monthly, even quarterly. Sometimes we have just one time a year expenses. Consider holidays. Are periodic. There's peaks and valleys to our spending, but the truth is we don't spend all of our income out at once. It doesn't all come in at once either. So as money washes in and hits the account, it impacts principal the day it gets there. Money tends to loiter around waiting to be spent for many days, sometimes weeks on end. And while it's waiting to be spent, that's referred to as float. Now, float is very valuable. In today's environment, our traditional environment, it's very valuable to our banks, right? Less valuable to us because we're, again, yielding less interest on our money than we have to pay out on our debts. This changes that paradigm automatically, where we can effectively save more interest than we could earn with those funds while they remain liquid before they're spent.
And this is the power of this loan. So this is where the rubber hits the road right here, is that this float money that you're using pays down the balance, you pay less interest. And I've shown people, we have a simulator that we can use, and I've shown people how they can save hundreds of thousands of dollars in interest and pay off their loan in 10 years, 11 years, 12 years, way sooner than on a 30-year fixed rate mortgage. And the critical piece of this is that you do not have to change your monthly, daily habits of spending. If you are
cash flow positive,
you make that, you have a budget, you stick to your budget, you are going to pay down this loan faster just by using that float money. So it's super important.
And one of the reasons why it drives down the balance faster automatically is, and this is sort of a light bulb moment for a lot of people that come to learn about the product, is that, if you didn't have to make a mortgage payment, where would that money reside? The money that you would normally budget for a payment? Well, naturally, it would land in your checking account. And in the all-in-one loan checking account, it drives automatically towards principal. It's already there. It's already committed to pay down the mortgage balance. And from that point forward, the customer doesn't need to commit it to an outside mortgage or a lender or in the form of a traditional payment. We are essentially converting a principal and interest mortgage payment into a 100% principal payment or principal pay down by way of making that deposit. So imagine if I'm somebody who makes, call it $10,000 a month, and I have a budget that allows me or affords me a $3,000 principal and interest payment on a traditional loan, and maybe I spend an additional $6,000 out towards my living expenses, leaving me maybe with about $1,000 or 10% of my net income left over, just didn't need to spend it this month ongoingly. Well, in an all-in-one loan environment, that $10,000 drives down my balance. I spend my $6,000 out like I normally do on my living expenses, and guess what? I've paid down my mortgage balance by $4,000 that month, in 1 month. And that effect compounds into a lower starting balance in month 2, and less interest cost during month 2. The whole point of the loan is to drive our cost down to zero sooner in our life, instead of being stuck with a stagnant payment obligation for 30, 40, 50 years.
Yeah, compare that to a 30-year fixed rate mortgage. During the first 5 to 10 years, the amount of principal that you're paying down is very little compared to what we're talking about, paying it down $4,000 in principal just in that 1 month. So,
that's right.
Okay, so tell me, let's go into a little bit further here. The buyer accepts this loan that I'm selling to them, this all-in-one loan, right? And we find a house, we close the loan, and tell me what happens, the day that we close that loan. What's different than a regular loan, and then how is the checking account set up?
Well, I would say the difference in this product versus any other traditional product really begins even prior to closing. As you mentioned earlier, we have a method to forecast benefit, and that's part of the, obviously part of the introduction to the loan.
Yeah.
And as we take out an application, even in underwriting, it's a requirement for our underwriters to actually analyze the forecasted analysis that's driven from our interactive simulator, and that's compared to a traditional loan. We want to make sure that this has a extraordinary financial benefit for people over traditional financing. And when it becomes obvious, like you said, sometimes in a lot of cases it's hundreds of thousands of dollars in interest costs completely avoided, and a lot of years saved. So that begins to unfold during the process in underwriting, and then right before we actually draw documents to close. We perform what's called a QA call, a quality assurance phone call. This is performed by our interim servicing department, our client liaison team. Reach out to every single borrower. 100% of our all-in-one loan customers are contacted, and they have a conversation that follows a script. And essentially, we want to make sure that each and every single customer has every one of their questions answered at that point, and we're structuring and closing the loan as anticipated, as they expect. And we want to keep people engaged, because you can start saving right out of the gates with this product. We want to keep them engaged. Right after we close the loan, another communication event occurs where they receive an electronic what to expect and congratulatory message from us, and that helps answer a lot more questions and keeps them engaged. About 30 to 45 days after that, a customer will receive their banking features. The account is completely activated. They'll receive their ATM debit point-of-sale Visa cards, and instructions with temporary passwords to log in for the first time and set up their account, their bill pay, all this stuff. Customer service team is also available to walk them through it verbally over the phone. It's a real white glove kind of high touch
treatment.
Yeah, treatment to make sure that people are off and running in the right direction and remain engaged. And I say that, I repeat that, because I think a lot of us can identify with getting a mortgage, and man, you're just so relieved after it's done. You don't want anything to do with it for a while, right?
Yeah.
Well, we want people to continue to be engaged and excited and begin using it as soon as it gets activated and they have access to it. That first deposit means they're on their way. They're starting to save. You're building equity in your home more aggressively, automatically with your own income. Why not get started as soon as you can? So we want to help kind of create that mindset.
Okay, so now a lot of questions that I get around this is that, and you kind of referred to it a little bit earlier, which is at midnight, a lot of things happen, right? So checks are coming in, bill pays are coming in, your income's coming in, your mortgage is saying, I need to give the money back to your checking account and pay the bills. What happens?
So it's all automated. We like to kind of use the term set it and forget it. You're making a deposit hopefully the day that you receive income. And by the way, it's not required to use this as your primary banking engine. The customer doesn't have to do that. They can still use their account that they're used to using, but this creates an opportunity to use those dollars more efficiently. So obviously, the sooner money impacts or hits the checking account, the sooner they can be swept over that day towards mortgage principal, reducing what's owed, therefore offsetting the cost during that month and on forward. So at midnight, the sweep occurs. The ledger is detailed, meaning that it'll show the deposit that was received securely into the checking account and that was swept to the mortgage balance. The mortgage balance reduces, and then interest is computed that evening right after the sweep occurs as well. So literally, Mike, you're waking up the very next morning, and you can log in online or open up the app and simply see, there was my $5,000 deposit yesterday,
right,
credited to my mortgage balance last night. Today, my checking account shows zero. It's a zero balance checking account that swept my money over, keeps it liquid in the all-in-one loan mortgage security, which is the 30-year line of credit, and everything's visible, so you can actually see how much money you have available, the credit limit that we've approved the customer in underwriting originally, and from there, the use of the money is just like any other normal checking account. You pay a bill, money comes right back out. There's no manual movement of money back and forth. It's all automated. And
2 statements? Like you have a checking account statement and a mortgage?
It's a consolidated statement.
It is consolidated as well.
Statement.
All in one.
Yeah, all in one. The portal online is also integrated, but you can toggle in between the two really and see the ledger, right? And that's a lot of regulatory, banking kind of rules centered on this. And so, we want our customers obviously to see how the banks are, utilizing, how our bank partner and servicing is utilizing that money. You see the deposit come into the FDIC insured deposit account, which is a processing account, routing number, account number. You see it remain there until the sweep occurs at the end of the day. And then you can also toggle to the loan side and see how that principal balance was just reduced by the credit from the deposit. So everything's ledgered and visible for people to see on a daily basis, and statements are cut at the end of the month on the 1st actually, and that's when a customer can see all their activity for the monthly cycle, including their total interest cost for that month. That's their interest payment. And that interest payment, by the way, Mike, isn't due until the 21st of the new month. Each following month, the interest isn't due until the 21st.
So
right?
There's more float there.
There's more float. It's a very simple or little detail, but it has a large impact. It sounds like nickels and dimes that are being saved, but that leads to hundreds and even thousands of dollars that are saved automatically, and that grows. That savings benefit compounds because you're literally leaving money in that you have to allocate towards the mortgage expense on the 21st, the interest, for an additional 20 days of float, right, before it's drafted out for you.
Yeah.
So the benefit doesn't end.
Yeah, that's great. So let's switch gears a little bit more. So we've gone through a lot of the details and how the nitty-gritty of that, how it works. Mm-hmm. Let's talk about the interest piece of it. So it's a first lien line of credit, 30 years. It's a variable rate loan.
It is.
Right? So it changes every single day or every single month.
Once a month.
Once a month, okay. It's tied to the 1-year CMT.
That's right.
Constant maturity treasury, right? Why, as a borrower, we've talked about how the interest is calculated on a daily basis. Mm-hmm. But why would somebody take this loan, a variable rate loan? In fact, I've had a borrower say, is this a variable rate loan? And I said, yes. And he said, I don't want any part of it. Well, why would somebody want this versus the 30-year fixed rate mortgage?
Well, I think that's a mistake to have that sort of canned response.
Yeah.
I understand why. We've been sort of conditioned over time to,
right.
And so I understand it. And but the reality is, loans, like all financial instruments, are just a mathematical equation. And this equation, comprises of 3 variables that equate into the cost, right? So if we're truly concerned about the cost you have to pay over time, as well as the monthly obligation, you should be looking at those 3 variables and how money is applied to those 3 variables. The 3 variables are, of course, the interest rate. The interest rate always matters, but also the balance in which the interest rate is being applied and the length of time you're going to carry a balance. So time and balance or principal actually they play a very large role and have even a greater impact mathematically compared to just the interest rate exclusively. And what people tend to do is really sort of gravitate towards a fixed rate mortgage with the lowest rate possible. And what the trade-off is that same person is agreeing to remain in debt for longer,
right?
Which means that their balance is going to remain higher than is necessary.
Yeah.
Okay, in which interest is being computed on. So, and one of the best ways to measure sort of the cost of a loan is really to, I think, what I do is I divide in the total interest obligation into the principal balance being borrowed. And of course, the interest cost is relative to the term, to the time, and the interest rate, and the original balance, right? Yeah. So, as an example, whether it's $100,000 being borrowed, or $1 million, or $10 million being borrowed, if the repayment plan is going to last 30 years, and you're borrowing that money at 6%, as an example, it's a fixed payment. That's going to cost that customer 116% relative interest compared to the principal they're borrowing. So, in other words, for every $100,000 they're borrowing in principal, they're going to be charged $116,000 in interest. Borrow $100,000, pay back $216,000. Yes, you may have a payment that doesn't move, but what you also have is a structured interest cost or load on your life that is going to be very hard, very difficult to avoid. And what the all-in-one loan solves for is less about interest rate, but about interest dollars, the cost of the borrowed funds, and it does that by impacting what's owed and how long you're going to owe it.
Right.
The rate structure on the product keeps it keeps our customers' cost aligned with our own cost, which is why we chose this index. And it makes it much safer for us to lend in any environment, whether rates are low or high. This is a very safe, reliable, dependable product for us to put out there. There's a reason why when rates go up, credit begins to tighten up, right? Lenders begin to pull back. Well, that's because they probably have a whole lot of fixed rate loans with lower rate levels on their balance sheet, and they need to drive, what they're losing in value on that side of their portfolio in the form of cost, right? Higher cost for new loans. And this is the game of the lending industry. This is kind of what occurs time and time and time again. The all-in-one loan is structured to where the interest rate is predictable. It is aligned nearly identically, historically speaking, with the Fed funds, which is used by the Federal Reserve to set monetary policy. So it's very predictable. And it remains aligned. Yes, it can move once a month, but it's predictable in nature. But what matters most is what the balance is, how fast is it reducing, and how long people are in debt. Again, the question becomes, can I save money and time even if the rate were to adjust, and even if the rate were slightly higher than what I have for a traditional loan? And the answer to that is potentially. Everybody's different.
Right.
Everybody's different. And that's the biggest benefit of the product.
When you put it up next to the 30-year fixed, and people have the 30-year fixed rate normally for 5. Let's say that it's 7 years because now their rates are so low, right? So let's say they had it for 7 years. The amount of principal that you paid down on the 30-year fixed, if you made the normal payment versus the all-in-one loan, is a significant difference.
Dramatic, yeah. I mean, a standard 30-year loan, you're for every $100 spent on a mortgage payment over the first 10 years, only about $22, $23 of that is actually going towards principal. The rest is going towards interest costs. So, I also look at this from just a practical standpoint, a regular human being. How is my money being used? Is it really going to benefit me more today than other people? The reality is no. With traditional loans, it doesn't. It really kind of feeds the lender.
It's a short-term mentality for the borrower.
That's right. Versus sort of an investment in that real estate. It's supposed to be an investment, right?
Yeah.
And one of the ways you can best utilize your money is to attack principal, attack the amount of time, reduce those things more aggressively. But the all-in-one loan does those things without forcing a budgetary change. There's no lifestyle, change requirement. We're just bolting on where money flows through, which is a checking account, with the mortgage commitment, which is statistically the biggest, expense that we commit ourselves to in life, to help people just get out from underneath it, have an easier time doing that. By the way, you're building equity in a property. That's what you're doing. By paying down principal, using an all-in-one loan, you're actually developing equity in that home more aggressively without relying on home appreciation, which isn't material, right?
It's not material until you sell your house.
That's right. You have to liquidate. You have to sell your home or go get another HELOC, to actually have access. The all-in-one loan keeps those dollars liquid and available for use 24/7 over the 30-year term. So, you know, it really kind of solves for the mortgage. One thing I like to say is that, you know, it's not just a mortgage, it's really a solution to the mortgage itself. It's healthy for both bank and borrower because it reduces risk and deleverages the debt load and cost.
So you said something there that it's beneficial to the bank. Why would, you know, basically a bank, we're using our own money to pay down our mortgage rather than the bank using our money to go fund somebody else's car loan or credit card or what have you. But why would a bank want to actually have and lend using this all-in-one product?
Yeah, we get that question, you know, commonly, as you know.
Yeah,
you know, and again, I don't disagree with the skepticism. You know, we're not really known. The mortgage industry is really not known for innovation and pioneering things that put the customer or the consumer out front. This truly is and does. The reality is that. By paying down what's owed on a home in terms of the mortgage balance, it actually reduces risk, right?
It
reduces risk for the bank. It also reduces risk for that customer.
Yeah.
Beyond that, keeping that money liquid allows that individual to navigate. Because we know life, if there's one thing certain about life, it's that there's a lot of uncertainty about life. And you know, there's curveballs that people are thrown, you know, on a yearly basis that they probably didn't foresee, they couldn't have predicted. And because the all-in-one loan is a 30-year open-end mortgage, it keeps those dollars liquid. It allows a lot of, I guess, maneuverability for people, a lot of optionality, and navigating, you know, challenging times, but also maximizing, you know, and executing on some of the opportunities out there to grow wealth and security. This reduces the risk for us of delinquency or default because of those two factors. Another thing is that it also creates a stickier relationship for us. You know, helping people get into a mortgage that ultimately allows them or provides an easier way for them to get rid of the debt as fast as they want to or possibly can means that we're likely not going to lose that customer to a refinance or another loan. And as you pointed out earlier, you know, the average lifespan for a loan is about 5 to 7 years, historically speaking. So if we made somebody a 30-year fixed, you know, we are likely going to lose that person within 5 years because rate reduction or some other need.
Right.
Maybe they need access to equity money and they find a reason to do a cash out refinance using, you know, another 30-year loan. We don't lose customers to those, you know, to those reasons on an all-in-one loan because it's already built in. You have those.
It's accessible. The money is
that
there.
access. It's already there. So
and the rates are coming down.
That's right. It's a reliable product that reduces risk for us and just creates a stickier relationship.
It's a very, very flexible loan. Would you consider this an interest-only loan?
Great question. I would say that the minimum payment obligation on it, you know, technically is interest only. You literally don't have to put money into it, and just if you're maxed out on the all-in-one loan line of credit, in other words, if your balance is equal to what we've approved for the credit limit, you know, the only deposit necessary to reduce the principal would be just the amount owed in interest each month, right? Because the interest payments are drafted off the line on the 21st of each new month. So you have to have enough credit in there for that draft to occur and not risk delinquency.
Okay.
So technically, you could treat this as an interest-only loan, but I really refer to it as a principal paid first mortgage.
Yep.
You know, that's really what it does. You put money towards it, regardless of the amount or the frequency or the day, the calendar day, and 100% of that money goes directly towards loan principal in order to reduce the interest cost that month. And so, yeah, there's really two ways to kind of look at it. You can use it as interest only, but really ultimately it's intended to help people reduce what they owe by paying principal first.
So, just for an example, so that I can we can show this on the screen here, is that if I used my American Express card for all my purchases, I went and bought groceries, paid my utility bills, everything. Let's just say I used it for everything. Is that a good idea to use that and then That way the money is, your balance is lower for a longer period of time, and at the end of the month you write the payment out of your all-in-one loan to pay off your American Express.
Yeah, absolutely. I mean, you're already getting a reward, right, for using the credit card,
Right, yeah.
right? So this just kicks that reward up another level, I believe, and a lot of people do that. Although we don't advocate to go out and start spending,
Right,
you know, your money on a
yeah.
credit card, but if somebody is already doing that, and I would argue that a lot of Americans, probably most Americans, are utilizing some form
Yeah.
of credit to pick up some gain, some benefit, some reward. So utilizing that strategy, you know, certainly helps keep money floating in your all-in-one loan against mortgage principal for longer. You know, that could be an extra 30 days of float
Yeah.
before you have to pay that bill.
Yeah.
And so it just continues to accelerate the benefit,
Of it.
compound the savings.
Nice. Okay. All right. So that's a lot about interest. That's a lot about just paying off your house faster, paying less interest. It is such an amazing loan. It's almost so much that it's almost too good to be true, but it is a mathematical equation
That's it.
that you use to actually pay less interest. So it's a great loan. Let's switch gears a little bit further here, and let's talk to the real estate agents that are out there. What, you know, when they're out talking to a client about selling a house or selling their house for them, why is this such a good loan program? Even in today's market with, you know, really high interest rates, people have a 3 or a 4% mortgage on their house right now. They don't want to move because they don't want to have that they don't want to get a higher interest rate and pay more interest. So what would they be telling these sellers out there to sell their house?
Yeah, it's a great point, and you hit the nail on the head. I think that's I would say that a lot of these same folks that may not be executing on what they would like to do, it doesn't necessarily mean that they don't have other goals, right? I would argue that a lot of people are having conversations at home about, you know, buying a bigger home or buying to a better neighborhood, or you know, maybe buying a second home where they would love to vacation, or an investment property. Those conversations are had at home, and
job transfer,
new job, all these
all those
reasons
things.
to be mobile. You know, people want that mobility, and you know, by and large, a lot of our housing market that are currently homeowners do speak about that, and they're having those conversations, and they have those goals. Be able to execute on those goals is a different story, of course. And I don't know that real estate agents or us, you know, in the lending industry, you know, get those phone calls. I don't think that phone calls are made to us saying, hey, we've been talking about, you know, potentially buying up. Our family's growing. We need to do this, or hey, they rezoned the schools, and we're not in the area that we want to be in, the high school we wanted our kids to go to. All these different reasons why people consider moving. We don't necessarily get those conversations or those phone calls, you know, to engage our clients, our mutual clients, to help them figure out if that's even possible. And I think that's because a lot of people that are in their current mortgages with low rates and sort of the one-way, you know, forward amortizing products don't believe it's possible. And I don't blame them. You know, we all sort of act and function and make decisions based on what we know. We don't know what we don't know.
Yeah.
And I think it's important for us, you know, here at CMG Home Loans, as well as our referral partners, our real estate agent partners, to talk to customers about the opportunity that the all-in-one loan provides, that mobility factor. What if you could buy again sooner in your life? What if you had the option to do that because of the mortgage? Because the mortgage keeps your money liquid. You can gain 24/7 access to your home's equity money. You could reduce what you owe. So if you did choose to sell your home in the next 6 months, you could probably do that with a lower balance. Even if you chose to maybe convert that into an investment property, you could have your cash flow off the investment property to pay down your balance. The optionality of the all-in-one loan actually opens doors, I think, to all these extraordinary opportunities for people to be more active in real estate. I mean, frankly put, if people had more money available, they would probably be more active in real estate.
Yeah.
And this loan is engineered to help people avoid the cost.
Yeah.
Right? So
and realize more homeownership dreams that
That's right.
investment homes and so forth.
That's right. So I think real estate agents play a big role in helping to spread the news. And I also believe that real estate agents are really kind of at the tip of the spear. They're ultimately having to create new relationships and develop out the pathways to home ownership and helping people realize those goals. But it's also very hard to create those new relationships, and I think that they come by way of creating new conversations.
Well, let's talk just a little bit more about the referral aspect of this product. Like, I think people talk about this loan, and if they talk about this loan and they're talking to their friends about this loan, and they're saying, "Oh, I used Susie to help me buy this house, and this all-in-one loan is an amazing loan, and we got it from Mike at CMG Home Loans." They keep on talking about it. So the referral aspect of this just keeps on going further and further.
It's extraordinary, and people are they're gratified with how it performs. We hear from people all the time talking about, goodness, I had 22 years left on a mortgage, and we were sort of locked in, didn't really know how we were going to retire or even if that was possible. Fast forward 18 months later, they're debt free on that property. They still have the all-in-one loan line of credit in place, and they're now executing on buying a vacation property up in Lake Tahoe.
Yeah.
I mean, these are the types of this is the type of kind of response that we get routinely from customers. And guess what? They talk to people. They have friends. Like-minded people tend to gravitate towards each other, and and it just leads to additional veins of opportunity, is the way I put it, with helping other people buy again sooner. Buy second or third property, reinvest in the home they already have, and just frankly put people in a better financial position. And people talk about that.
The affordability on this loan as well. There's a couple of features that I would like you to kind of just touch on a little bit that are a little bit different than you might find in a regular conventional loan. One of them is the asset depletion. Mm-hmm. So go into kind of how that might help somebody qualify for this loan.
So asset depletion is refers to a method in underwriting to help somebody qualify who has been a good saver. They have assets. That doesn't necessarily mean cash in a savings account. It means retirement funds and other types of assets that have been out, gathered over time. Right. Well, for that individual that's done a good job of allocating or gathering assets and money, retirement funds, et cetera, we look at that individual as somebody that should be able to qualify for this product, because it's really cash flow driven. The benefits are really from the flow of cash, right, and the proper management of that money. And so asset depletion, the method that we use is to take either 100% of those funds or a percentage of those funds, just depending on what type of fund it is, and also the age of the borrower, and we deplete that amount by 120 months. So in other words, the methodology is, what if this customer had to live off those funds only for 10 years? What would that dollar amount be on a monthly basis in terms of income? And that helps us ratio that individual, or help them qualify into the loan, where otherwise they might be self-employed. Yeah. They might be a W-2 wage earner who really doesn't have to work very hard and have to earn because maybe they've got a trust fund. Right. There's other, there's a variety of different reasons to supplements, right? So we're taking a look at this and saying, this is a strong customer, great credit history. They just don't necessarily document a whole lot of income on their returns or even their W-2s, but they have a lot of assets. Maybe we can use our asset depletion feature to help that person qualify. In most cases, it's awesome because when we do that, and if we don't, in the cases where we don't need any of the actual taxable income to qualify, we don't even ask for those returns. No tax returns, makes it really, really easy to underwrite. That. It's awesome. As a loan officer, that's great. We don't have to ask for tax returns. We're in good business. Yeah. So tell me about the delayed financing. So this is for maybe cash buyers that want to put a strong offer, cash purchase on of a house. Yeah. How does the delayed financing work? So delayed financing, in today's environment especially, this is a great feature because a lot of lenders have tightened up their guidelines and really now require extensive seasoning on properties to be on title before cash can actually be accessed. Equity in a property can be accessed, and we've not followed suit with this product. It's for a community of homeowners and home buyers that otherwise are well established with their financial behavior and their budget, and they've done a good job saving. They've got financial discipline,
right.
And we believe that same individual shouldn't have to wait to tap into their home's equity money after a cash purchase. So their delayed financing refers to the fact that we can actually take an application the day after that cash purchase closes, and structure a refinance, a cash out refinance without any seasoning. So the day after, no seasoning requirement, and that helps customers recoup a big portion of that investment in that real estate, all the way up to 80% of the value or the purchase price of that home they just purchased. Up to $2 million. So
incredible.
It's an extraordinary opportunity for those cash buyers to recoup that cash, redeploy it, buy again, go put it back in the market wherever it was, and now there's this structured instrument in place that makes it much more, I guess, easier to repay and avoid cost while also creating liquidity.
Accessible, leverage, pay it down, use
mobility,
optionality. It's amazing. In fact, I would say that somebody that owns their house free and clear, they should be at least looking at this product for a loan as well, just to have the accessible money available to them.
That's right. I think it's the high level of optionality that people have. Pay down, pay off was, I think, our original vision for the product, right? And again, as we started, that's what we went to market with. Along the way, we've learned that paying off your debt doesn't always make sense. It may not make sense for a lot of people. And in some cases, people are on such a rapid pace of mortgage payoff that they can just pull a lever and say, why don't I just start putting extra funds towards, investing, into the market or other things, and slow down my payoff. Maybe 8 years, I don't need to pay off in 8 years because I'm 42 years old. Maybe it's okay to pay this thing off by the time I'm 55. Right? And you can maneuver that way and reallocate money however you need. So for those cash buyers or for those people that have mortgages today, it creates that maneuverability factor. And I think that's invaluable. It's hard to place a value on that because, again, what you set as goals today, we know is going to probably change next year. And being able to do that and have this credit facility that's backing you, supporting you is pretty special.
And for the real estate agents, especially their buyers having this loan, like Dave said, is like it's the optionality of this gives them more options sooner to buy more real estate. And so this gives the real estate agent another option to help that buyer buy another piece of real estate.
That's right.
So let's switch gears a little bit to investors. So you talked about the beginning of our conversation, just that you can use it for investment homes, you can use it for second homes. Let's really focus in on the investors and why is this such a great loan for investors?
I think real estate investors, having been one in my life, really sort of are focused on two primary objectives. One being that they'd like to grow their positive cash flow position in a property. I speak to people who are hovering at neutral, sometimes even negative. And really the only options traditionally that people can, real estate investors can utilize to grow their position and create greater positive cash flow out of their real estate investments is to, one, refinance to a lower rate to reduce their monthly payment.
And start the process all over again.
But again, that's not always feasible because none of us controls interest rate cycles. So, especially right now, while rates are higher, relatively speaking, you're not really creating much opportunity by offering a refinance to that real estate investor who's looking to grow their positive cash flow position. The only other way that they could maybe achieve that traditionally is by increasing their rental income. Again, that's also something that's challenging. It's not always possible or feasible. You might scare away a loyal tenant, might price yourself out, with short-term rentals. That's a delicate dance as well. The all-in-one loan solves this because you don't have to do either. It's going to reduce the monthly interest payment obligation ongoingly just by flowing cash flow in and out. Imagine taking your rental income the day it's received and depositing that directly into your all-in-one loan that is secured by the investment property, and the mortgage balance drops by the rental income in total. Not just a little bit, but all of it. And that begins to offset and compound the savings, where the interest payment obligation reduces pretty aggressively month over month over month, and that grows your positive cash flow position automatically, right? You're creating greater separation between what you're receiving versus what you have to pay out, and that's a good spot to be. The better we can, the greater that is for somebody, the better they are off, I guess. And the other thing is that I think real estate investors are looking for liquidity, right? They want to be able to execute on that next purchase, or even repair or renovate, right, without having to tap into, maybe business funds, et cetera.
Let me tell you, just one of my friends, I had a conversation with him the other day. He's got 3 rental properties, 3 30-year fixed rate mortgages that I just refinanced for him 3 years ago. And he's got $100,000 sitting in an account over here just for repairs or making sure
operating.
That's his slush fund for these investment properties. And I said, why don't you take one of those investment properties, turn it to the all-in-one loan, which is a 3% mortgage, and pay down by $100,000. You still have access to that $100,000. You're going to pay way less interest, even though you have a 3% mortgage.
Well, the effective rate of interest is the better measure, right? Compared to that 3% mortgage he's getting rid of, we're now reducing the total interest cost, which means that the effective rate of interest, I'm guessing, is probably equal or lower than that 3% over time. So you're picking up that benefit, plus those dollars are more effectively being utilized, right? Not sitting idle, earning low interest versus paying higher interest. And I also believe that it's creating liquidity, right? There's a liquidity value there that makes it easier to tap into and go buy again with those funds, while those funds are being used to also help save. It's a very it creates opportunity for real estate investors. It makes it easier to buy and save and grow positive cash flow in the properties owned.
All right, so let's go one more step further here. I've got a financial planner, somebody who manages my money. Why would they like or dislike the all-in-one loan?
I can't think of any reason that they would dislike the all-in-one loan, to be honest with you. From a fiduciary standpoint, this loan really speaks to the holistic planner primarily, the individual who is tasked to pay attention to every cornerstone of our personal finances and developing wealth and financial independence and long-term security. I'm talking about insurance planning. I'm talking about just plain financial literacy. That's an entire industry out there. I'm talking about trust services, wealth accumulation and management, of course, but also liability management, helping people cut expense out of their life. It's a very hard thing to do, and in most cases, it's hard to make a large impact by just kind of changing some of the minor expenses that are reoccurring in your life. We make the joke that just because you're maybe changing your cell phone carrier from this to that, you may save $15 or $20 a month. You're not necessarily getting your retirement goals right back on track, but a holistic planner approaches it, more globally, broadly, and the mortgage tends to be the biggest
impact that you're going to have.
It impacts their personal well-being more so than any other obligation or singular expense, and so reducing the amount of interest people have to pay on that debt obligation has a very meaningful impact. Frankly put, it just means that people are left with more of their own resources to fund other financial needs with
sooner rather than later.
I mean, look at retirement security or retirement income. There's a deficit, of course, that's growing in the United States. It's massive. By all accounts, working households, about half of all pre-retirement age working households are not on track to pay for their current living standards during their retirement years, and they don't have long to figure it out. Well, the mortgage is one of those things that they may have a low rate today, but it's still standing in their way. I would say paying for their college tuition costs for children is also one of those obligations that people haven't really thought through much, right, and have figured out. what if you could supplement the cost for tuition because you've saved so much in interest costs on your home loan?
Yeah.
This leads to other opportunity, and for that holistic planner, that financial advisor that's really looking at all those areas, the all-in-one loan is a solution. It's a massive solution to an enormous problem that is continuing to get bigger for people.
Yeah, I think relying on Social Security income as we get older, there's less of it that's probably going to be available for us. So having your house paid off sooner and being able to save more money sooner is super important for you as you kind of plan out your life here. And having that 30-year mortgage and having the short-term thought process of a lower interest rate to have a lower payment and to refinance your mortgage every 5 to 7 years is not going to get you there. You're going to stay in debt longer and pay more interest. So rather than getting a 30-year fixed once, you get it 3, 4, 5 times throughout your life, and you're in debt forever on that loan. It has been a good loan for a long time, but the all-in-one loan is a way different look at your financial position and being able to have financial independence sooner rather than later is where we want you to get with this all-in-one loan.
I mean, goodness, everything else around us is innovated.
Yeah, right, exactly.
You can interact with your home through your doorbell.
The lights come on when you drive up.
You can turn on the oven from a mile away,
right
through a mobile app. I mean, goodness, it's just certainly time. And again, we've had the loan out for 18 years, but there's just less awareness about it still. It's not a mainstream product because it takes education.
Yes.
And forums like this are critical to helping people understand the issue and also the opportunity that exists by thinking differently and being introduced to a product like this. And it is certainly a form of innovation. I like to kind of make the joke that it's not a revolution, it's sort of an evolution, a necessary evolution in home financing. It creates affordability without a dependency on interest rate cycles always being favorably lower, period.
Yep. Awesome. Dave, thanks for coming on. I appreciate it and driving up here to do this with me. This is Mortgage Wise with Mike Wise, and today we talked about the all-in-one loan. You can follow me on YouTube or Instagram, and you can see more of the videos on other programs and other things that we offer as well. So thanks for being with us today. If you have any questions, please feel free to give us a call.